Hey everyone. Today I want to talk about a risk for Bitcoin that most people aren't looking at. Not the Fed, not Hormuz, Japan. One of the world's largest bond markets is undergoing the most significant transformation in a generation, and that transformation directly affects Bitcoin's price. Let's break it down together. First, let's understand the mechanism. It's called the yen carry trade, and for decades, it's been one of the biggest hidden fuels of global finance. Japan kept interest rates near zero for years, so big institutional investors did something simple but powerful. They borrowed yen for almost nothing, converted it into dollars, and poured it into US equities, bonds, and crypto. The profit came from the interest rate differential between Japan and the rest of the world. That trade, the yen carry trade, was the invisible engine quietly powering global risk appetite for decades, and Bitcoin was one of the assets that benefited from it. Now, Japan is turning that engine off, slowly but deliberately. And then June 16th, 2026, the fifth hike. The Bank of Japan raised its benchmark rate to 1%, the highest level since 1995. Bitcoin is currently down roughly 10% and still absorbing that shock. This is not a coincidence. It's a mechanism. When the BOJ raises rates, the yen carry trade becomes more expensive. Investors close their yen funded positions, meaning they sell risk assets, including Bitcoin, and buy yen back. That wave of selling hits crypto every time. So, where does Japan stand right now? This morning, BN Crypto reported that Japan's 10-year government bond yield hit 2.825%, its highest level since October 1996. The 20-year yield reached 3.555% in May, a multi-decade high. The 30-year yield is hovering around 3.5%, historic territory. The yen is trading near $162 per dollar, a 40-year low. Tokyo spent a record $73.6 billion intervening to defend the yen this year. It failed. Goldman Sachs now projects the yen could reach $165 per dollar within a year. And here's what makes this particularly dangerous right now. Yen short positions are at a 9-year high. That means a massive number of institutional traders have bet against the yen. If those shorts unwind quickly, if the yen surges unexpectedly, the rush to close those positions triggers selling across global risk assets. Bitcoin would be caught in that wave. Arthur Hayes says, don't bet against the Bank of Japan. His argument is actually bullish for Bitcoin in the long run. Even as Japan raises nominal interest rates, real interest rates, that is, rates adjusted for inflation, remain negative. Inflation is still eroding purchasing power faster than yields are compensating savers. Over time, that environment pushes people toward hard assets and alternative stores of value. Bitcoin is one of them. Hayes framework. Short term, BOJ hikes cause pain. Medium term, that pain creates opportunity. And in the long term, negative real rates are structurally good for Bitcoin. You're watching the Fed. You're watching Hormuz. Add Tokyo to that list. For 30 years, Japan operated at zero interest rates, quietly fueling global risk appetite. Now it's normalizing, and that normalization is shaking the yen carry trade. Bitcoin feels every tremor. Track the 10-year Japanese bond yield. Watch the yen. Those two numbers will tell you something the Bitcoin chart alone cannot.